There is a reason why price kept coming back to a certain areas in the chart, not randomly, not by chance, but because there was something left behind. Most traders do not even see this. Now, let me simplify it for you. A fair value gap is simply an imbalance in the market, a moment where price moves so fast it did not give both the buyers and the sellers equal anticipation in the market. Think of it like unfinished business. Price leave an area too quickly and later come back to balance it. That's why you always see price return to those zones, not because it wants to, but because it needs to. We have the bullish fair value gap and also the bearish fair value gap. But these three consecutive candlestick right here is telling a story. It's a moment where price move extremely too fast, not giving the buyers or the sellers equal chance to anticipate in the market. Most people call a fair value gap to be an institutional candlestick because buyers took fully control over the market. The next candle is where both buyers and sellers, they are present in the market anticipating who is going to take control over the market. But eventually, the bulls took control over the market. Now, this is how you can be able to identify and read what a fair value gap is. How to plot it, you just have to put your horizontal ray button around here and around this side. Now, you can see that this happens to be your fair value gap. So this is the area of your FVG. Sorry about my handwriting, okay? Now let's come on to the bearish scenario. Now on the bearish scenario, you see that the first candle, the first bearish candle that the market is going to present is where the sellers and the buyers was anticipating who is going to take control over the market. And eventually the bears took control over this market and it closed bearish. That's the candlestick closed bearish. Now the next candle just moved so fast. Now, the next one is where both the sellers and the buyers were present and the sellers took control over the market. So there was a fight around this candle and this candle. But this one, the bears took full control over the market. So you just had to mark it out like this, right? Not leaving any wick in between them. Now, this is your FVG. As simple as that. But most traders ignore this in the market, and that's exactly why most of them get trapped. Let me walk you straight into my chart so that we can be able to identify these on real terms. This right here is a bullish fair value gap. Just as we explained on the whiteboard, you can see that the first candlestick, both the buyers and the sellers, they were anticipating in the market. They were fighting who is going to take control over the market at this time frame. But the next one just moved so fast, so aggressive to the upside, so big and so fast. A lot of people call this an institutional candlestick. Now, this gap, see it like an unfinished business. Now, price usually come back here not because it wants to, but because it has to come back to the side to balance it. Now, this other one right here, you see at some point was bullish, bearish, and it closed out to be bullish because the bulls took control over the market. Now, how to mark it? You just have to mark it from here and here. Right? Then here happens to be your FVG. Sorry about that. I have a terrible handwriting. So this is a bullish FVG. Now let's move on to the bearish one. This is a bearish fair value gap. Now you can see how big it was. Now the first candlestick, both the bulls and the bears were in this market, but eventually the sellers, which is the bears, they took control over the market. Hence, the market closed to be a bearish candle. Now, here, the next one, they were not given equal opportunity to anticipate in this market. The market just opened and closed strongly bearish. Now, this is a bearish fair value gap, okay? Now, the next one, they were given equal opportunities. You can see this wick right here that the market left out. You can see this other one. It shows that the market was once bullish but closed bearish. It shows that the buyers were once in the market, but the sellers took control over the market. And more often, price gets to fill in those candlesticks, those fair value gap around here. You can see more often. Sooner or later, price is going to come back there and fill in those FVG. So now you understand what a fair value gap is in the market and why price reacts to them. But there is a problem, guys. A fair value gap is not enough. A fair value gap cannot be used as a standalone strategy. That's why on my next video, I'll break down a breaker block and how they work together with a fair value gap to give you a more precise entry. If you're serious about trading gold with precision, guys, don't forget to subscribe to this YouTube channel, like this video and turn off post notification because I'm going to be dropping such kind of content like this every Monday. Do not miss out on the next part, guys. See you on the other one. Bye for now.